Welcome to Dollars and Cents with Freedman Financial, the home for financial advice in a language you can understand. Created by Marc Freedman of Freedman Financial, he and his team of certified financial planner professionals will discuss timely topics that help individuals and families make smart financial decisions. And now, get ready for this week's edition of Dollars and Cents with Freedman Financial.
Welcome back to another edition of Dollars and Cents with Freedman Financial. I'm Marc Freedman.
And I'm Marion Gilman.
And here we are to provide you with some more financial advice in a language you can understand. Well, this week we had a pretty interesting start to the week. I had an opportunity to do something kind of fun.
Oh, yes. You had a very exciting day on Monday, didn't you?
It was really, really cool. I mean, I got to ring the bell at the Nasdaq in Times Square.
How exciting is that?
Now, so there's two lies I just told you. Number one, there is no bell. And I didn't actually ring it, but I was there behind the podium
what do you do? Press
where
the
they
button?
hit the button.
There you
I was
go.
standing right behind Rich Steinmeier, the
So
CEO.
they don't do it with the, with the bells, the chiming
No,
bells
there's none of that.
anymore?
And
Oh,
maybe
that's
there's
too
bells at the New York Stock Exchange, but
I don't think so.
I was at the Nasdaq, and all that there was is I was standing right over Rich's left shoulder. And
So you should explain who Rich is.
oh yeah, I'm sorry. Rich Steinmeier is the CEO of LPL, and he was there with his wife, and close to 100 of us that were behind him as well, there for the celebration where we open the market. That's what they call it. They ring the bell. But what Rich actually did was he hit. There's a camera on this small table here that's facing up at him, actually just where his hands would be actually, because he hits a button, and I guess that's the bell, and then he uses this stylus and he signs his name on.
Oh, that's cool. I didn't know that.
Which kind of
Wow.
officially launches the start of the trading day.
Yes, that's 9:30 a.m. Monday morning.
Yep,
You did that,
and-
right?
yeah, we did
And why was it? Why did you get to do this?
We were doing it because LPL was celebrating its 15th anniversary of being a public company. It was really cool. I mean, I was there actually 14 and a half years ago when LPL was celebrating their 6-month anniversary of being public. The Nasdaq studios have been upgraded dramatically since then.
15
Yeah,
years,
the
right?
whole experience was great. We went outside in front of Times Square with the Nasdaq building in the background. They lit up. LPL basically took over a lot of the billboards that were there with all sorts of
So it's
video
all blue?
signs, all blue, and some of their new ad campaign. And then they showed some pictures from the moment on the 7-story building of the Nasdaq. And I actually, if you happen to look at one of our earlier podcasts, I do a short one that I did from Times Square. As I'm doing it with the TV, with the tower behind me, my face appears on the screen.
So you were double.
I was double. It was really kind of cool. It just showed up
Awesome.
that way.
That's great.
Anyway, there's a lot of stuff going on right now. We have been so busy here at Freedman Financial.
Oh my goodness, yeah. End of the year is always very busy. Aside from the holidays, which sort of trips us up because, we have Thanksgiving week, which is really chopped up, and then we have we have Christmas coming up and New Year's coming up. So the markets are closed certain days and half days and lots of stuff going on in the office as well. And we need to prepare for the end of the year. There are some things that you should think about as we go into year end for your investments.
Yeah, there are the traditional things that you think about. Of course, you've heard this idea of tax loss selling or maybe making some estimated tax payments ahead of time, prepaying certain expenses, taking advantage of your FSA, using that money up in your flexible savings account so you don't want to lose that, making sure that you fully fund your 401ks and your Roths and all that kind of stuff. But in years when the market is doing well, there's a challenge that we all face in the month of November and December, right?
Right. For those people who have investments, not in retirement accounts, but in personal accounts, non-retirement accounts. During the month of December, there are many mutual funds that pay out capital gain distributions. This might be a concept you've heard before, maybe not. But those capital gain distributions are the profits that the mutual fund has realized over the course of the year as they bought and sold stock within the portfolio. So sometimes when you sell a stock, there are significant gains in there. And at the end of the year, the mutual funds are obligated to pay out any capital gains that are within the portfolio for that year, such that the mutual fund holders have to pay tax on those gains for that year.
Yeah, and this is kind of like the nerdy part of this whole thing, the quant stuff.
Absolutely.
But I want you to try to understand when you used to be able to go to the Wall Street Journal or any of the newspapers and see what the price per share was of a mutual fund. You rarely don't care at this point,
Right.
because it's already built in. But if you were to look at the price of the XYZ mutual fund, and let's say it's selling for $30 a share, how do they come up with that $30 a share price?
Well, they add up all of the companies within the portfolio, the price of all of the companies, and then they divide it by the number of shares outstanding.
Right.
So that's the price per share.
Yeah, because a mutual fund could hold 100, 500 stocks in it.
Correct.
It's the number of shares they owned of that stock, and that you add all of those things up, you divide it by the number of shares outstanding. And frankly, that's a job that a college student gets out of college. It's called mutual fund accounting.
Oh, that's got to be. Remember, mutual funds trade daily. So at the end of every day, they have to reconcile every stock within that portfolio, the new price of every stock. And they move every day.
Now, I think computers have come a long way and probably do a lot of that
I'm
for
sure
them.
they
When it was
do.
more of a manual process when I was getting out of college.
Me too.
But so you get this whole long list of the stocks, number of shares, but there's one other item that gets added in there. And that item is a bucket of money that represents all of the realized gains that the portfolio manager has had for the year. So let's say they had Coca-Cola in the portfolio and they paid $1 million for it and they sold it for $1.5 million. Well, $500,000, that gain, has to sit in this bucket. And the bucket just stays there until the end. Now, it's filled with gains and losses.
There can be losses in funds as well. The price per share can go down. So it nets out, though. So any gains, you can subtract out the losses. So you get the total for the fund.
So, for instance, they might come up with a share price that you'll see right now. The mutual fund might be selling for $30 a share, but perhaps $2 of the $30 represents all of the gains, all of the net gains that have been sitting in the portfolio.
Right.
So by law, the mutual funds are required to pay that bucket, pull that bucket out, share it with you or reinvest it, but they have to pay it out. Thus, the stock price or that fund price will drop from $30 to $28. $2 comes out. It gets reported to you. If you're in a non-retirement account, that is called a capital gain distribution. Now, whether you take that check or reinvest it back into the mutual fund, you still have to pay tax on it.
Right. And so, just to go along with that price drop, you will sometimes see all of a sudden, from one day to the next, one of your mutual funds drops precipitously in price, and yet the market was up. And you're looking at it saying, what is going on here? No, it has not lost money. It just got paid out in the form of like a dividend payment. It's very similar.
Dividend got pulled out,
Right.
but sometimes it doesn't return to your account for maybe 2 days.
That's right.
And so it's a little bit of an imbalance that happens. So don't be surprised if you see this happen in the next couple weeks. You say, why did my mutual fund go down when the market might have gone up or was flat? That's probably what's happening. But
word of warning, just don't look every day.
Yeah, that's it too.
Anyways,
But one of the things that we've learned, and so we've been going through every one of our clients' non-retirement accounts to try to understand what that capital gain distribution collectively will be for each of their accounts.
Right.
And Christian is working diligently on this. He's built a spreadsheet and a software system.
Right.
And so I want you to think about if you have a non-retirement account, don't be surprised if that extra distribution, that extra capital gain dividend, is about 5% of the value of your account.
Yeah.
So if you have a $500,000 non-retirement account and you're in a mutual fund portfolio, and it's going to be different for everybody. I'm using this purely as an example. Don't be surprised if there's a $25,000 capital gain distribution.
Right.
And you'll have to pay tax on it.
That's right. Now, the good news is you made money. I mean, this is a positive thing. It's not a negative. You made a lot of money in that fund. Unfortunately, tax man comes calling. And here's the thing. No matter what, at some point along the way, if you're going to use that money, you will pay tax on it. It's just that it might not come in the year in which you would like that to pay taxes on that. It could be in a big tax year.
So there's two things to remember here, and we've talked about this almost every year when we do this podcast.
Right.
Number one is if there are tax losses in your portfolio, it's a great opportunity to look at those, take advantage of the tax losses, so you could potentially offset your capital gain distribution with the losses in your account.
Right.
The problem is this year, who's got losses?
Nobody has losses. So,
well, I wouldn't say nobody. There are some people that have losses.
Absolutely. I shouldn't say that, right. However, the past 5 years, or the past 3 years in particular, have been exceptional years. Back in 2002, it was a really lousy
2022.
year. I'm sorry.
2022. 2002, Marion. It's 23 years ago.
Well, you know something? That was a negative
year. It might have been a negative year.
But anyways, 2022, there were a lot of losses. And we went through the portfolios that year, and we were selling like crazy to take advantage of those losses and save people taxes. However, all the losses are now gone, and now the market's just gone up steadily. So there are very few instances where we really have any losses in the portfolio.
So that was option number one, but the number two is the tricky one. Number two is, let's say, for instance, you decided to buy a mutual fund on December 1st.
Right.
You put $50,000 into the fund, and it's pretty much stayed the same. But if you bought that mutual fund and it's expected to pay a capital gain distribution, you may have bought the fund with an embedded distribution, which could come out, and you'd have to pay tax on something that you didn't even make any money on yet.
Right. Even though, you didn't make those gains, they accumulated all year, and that's, when you invested, you inherit that.
Yeah, so part of our due diligence when we're building portfolios for our clients is being mindful of the fact that though we want to be invested in the market, we want to purchase mutual funds. If we're going to purchase something in December or November, we want to be aware of what that capital gain distribution is going to be prior to buying your fund.
That's right.
To avoid unnecessary taxes for you.
Right. And also we look at, particularly if we're going to sell a fund and we need to reinvest it in something else, then we look at it and we say, okay, well, when is that something else going to pay a capital gain distribution? And we wait until after that distribution is paid, because we get all the information on the dates of the distribution and the amount of the distribution. So we can tell what's happening.
Yeah, at Freedman Financial, we're managing close to $900 million right now.
Right.
And 670 some odd households. So there's a lot of accounts that we're keeping an eye on, many of which own exchange-traded funds and stocks, many of those which don't pay a capital gain distribution, but mutual fund holdings are something that a lot of our clients have.
Right.
And many clients will say to us, well, Marc, why are you still owning mutual funds? Why don't you move them to exchange-traded funds where I don't have to pay a capital gain distribution? And Marion, what's our answer?
We would love to do that in many cases. There are two reasons that we don't do that wholesale. One is that we have clients that have owned mutual funds for so many years that the tax burden would be onerous if we ever sold those. The gains are much more than what they ever invested.
Yeah. So moving from, the XYZ mutual fund to the XYZ ETF, even though it might even be the same name, is still right now a taxable event.
That's
we have to be very conscious of that.
And the other thing I have to say about this, because I actually have a preference for mutual funds in certain areas of the market, certain asset classes, in particular international funds and bond funds. You have an active manager in there, actively trading those funds to go into the different areas of the market that look promising at that time. So an exchange-traded fund in many cases, and now it's changing a little bit, but back in the day, there were always just index funds. They bought every security, good or bad.
They had to.
Yes, exactly. So when you look at the foreign markets, that's a tough thing to do, just to buy every security, because foreign companies are very unlike U.S. companies in information that they distribute. And then in bond funds, bonds don't trade all the time. So you need somebody knowledgeable to understand what they're buying and selling there.
Yeah, so a big part of what we do, especially in November and December, is this tax planning component. And what we're sharing
That's
with
right.
you is just one of the things that we're doing for you, proactively for you.
Right.
Many people neglect to understand what's going on. They find themselves with these surprise capital gain distributions that they don't even know about until they go to do their taxes. And then their accountant says, oh, by the way, Mr. and Mrs. So-and-so, you have a large tax bill. And for whatever reason, the clients sometimes get upset with the accountant. Oh, I've got a bad accountant.
Not their fault.
It's not the accountant's fault. They're just providing what you've given to them. So one final tax thought before we get out of here is the idea of cost basis. If, for whatever reason, you sold a security this year and your brokerage account doesn't have record of what the cost basis was, what you paid for the stock, and we see this happening a lot with a lot of investment companies that take over the management of another person's portfolio,
Right.
and they neglect to post the cost basis, what you paid for it. If you don't have the cost basis on there, the accountant is going to see that you paid zero for your investment.
He doesn't know.
What do they know?
Right.
It could have been a gift. It could have been a gift. It could have been you could have paid nothing. They don't know. They're just going based upon what the piece of paper is. If you don't have record of that cost basis, you're in trouble.
Right.
So find it. Work hard to get it. Don't be surprised by your accountant when they say, "Oh, we need cost basis now," or "Why is your cost basis only zero?" Have that ready.
And one last item, and that is, people will say, well, why don't we do this in the IRAs as well? In an IRA, everything that you take out of that account is taxable income to you. Anything that happens within the account, any capital gain distributions, not taxable to you in the year in which it happens, only when you take it out.
And that's what we call, let's be a little bit more complicated, but financial advice in a language I hope you can understand.
Yeah.
We tried to be a little bit softer, but we thought it was important to bring this technical aspect of what capital gain distribution planning is all about, because it's something that we take so seriously in our office, to making sure that we're placing the interests of our clients first and helping them to understand what their tax liability might be.
That's right.
And so if now's the time for you to get serious about your financial planning or investment management needs, I hope you'll give us a call. We are accepting new clients presently, and of course into the first of the year, though the end of this year is getting a little tight. So let's start making those appointments for after the first of the year.
Right.
Our website, freedmanfinancial.com. That's Freedman.
2 E's and a D.
Financial.com. Go to the bottom of any page. You can put in your name, your email address, and get our free weekly newsletter called Planning Pointers. It lands in your inbox every Friday at 10:30 a.m. That's going to do it for us this week. We'll be back again with more financial advice in a language you can understand on Dollars and Cents. Thanks for watching, everybody. Have a great week.
Enjoy.
During today's episode of Dollars and Cents with Freedman Financial, your host may have discussed specific financial planning and investment ideas that are for general information only and not intended to provide specific advice or recommendations. Please remember that investing involves risk and may include loss of principal. Always consult a certified financial planner professional, qualified attorney, or tax advisor prior to investing to determine what is appropriate for you. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.